So it's great to have everyone here today. And in this webinar, we're going to be joined by Ray Amani, the leader of the NASDAQ Index Partnership Team, who has an extensive background in ETP product management and development. Ray has launched several innovative ETPs and established tactical ETPs with boutique asset managers. With his expertise in portfolio analytics for wealth management, he will share his insights on the latest initiatives and technologies used in constructing indexes. Ray also holds a master's in technology management from Georgetown University and really is the perfect person for us today to discuss fixed income. Why now? Ray, how are you?
I'm good, thank you. Much better now that I'm with you guys.
Amazing.
So sorry about the glitch as well.
Yeah, no, I'm really looking forward to it. And I think it's going to be interesting to look into fixed income as a potential sort of alternative to equities in this current environment at the moment. As we just sort of go and move on to the first slide we've got here. I mean, look, the title gives it away, but what are we covering today? What have we got in today's presentation to discuss, and why right now is it important?
Yeah, that's an excellent question. And so we want to cover the basics, but also talk about the indicators that the institutional market looks at. And so prior to NASDAQ, I worked for a fixed income credit shop, Guggenheim Partners. And so what we did there is we had a number of passive products, ETFs that tracked indexes, and we also had actively managed products as well. So the whole scope of fixed income instruments are things that I've studied and also have utilized in these products. And so what makes these unique is you have to understand the whole scope of the instruments, the treasuries, treasury bills, treasury notes, treasury bonds. What's the difference between them? The tenor is different, duration is different, the risk is different. And then there are other instruments on top of that, corporate bonds. So corporate bonds are graded into investment grade or high yield. Obviously, the yield is different compared to what type of bonds you buy. Do you buy individual bonds? Are you taking what type of risk? Or are you buying a basket of products, Sam, as in a fund? And those funds can be actively managed by a manager, or they can track an index. And so what we do at NASDAQ is to construct these indexes. The indexes can go across these sub-asset classes. They react differently to rates, to risk. And we want to understand, as an investor, you want to match your risk level, your investment time horizon to the proper investment, always, whether it's bonds, equities, alternatives. And so with our ability to construct these indexes, what we do here is to create these passive products. You can see here in the notes, I don't want to read it to everyone, but some of the points are highlighted as far as risk. And we'll walk through some of these slides. There are different screens and information that we've created using either Bloomberg, which is a service that tracks the different instruments, the indexes. Without making any recommendations, I want to give kind of a flavor for what's available out there. And if you are an eToro club member, you want to understand the whole gamut, how it works. I think that's what we wanted to cover today. And I'll go into some of the more specifics as we get to the slides. Does that make sense? Is that a good goal?
Right. Yeah, absolutely. I mean, look, it's really, really interesting time in the market. And actually, just before we go to the next slide, those at home, I want to know in the chat if you are currently investing in fixed income, if you have before. Let's just sort of get an understanding of where people are at the moment. A little bit of show of hands in the chat would be great. I mentioned there that it's a really interesting time in the market right now, and really has been for a few years. When it comes to performance over the last 18 months or so, how have you seen it? And what does this chart that's on the screen show us here?
Yeah, absolutely. So here we plotted various bond indexes against each other to see what kind of signal it provides. And so it's not a complete picture, but it does tell you that during 2022, the regime changed, right? Interest rates started to go up, and the various performance as tracked by the lines, and there's a legend up top. But the point here is that when rates started to rise, the performance of a fixed income basket changed. And now you're seeing indications that things are leveling off, that the regime is investors are adjusting to it, and now makes a good time to utilize fixed income for its benefit, which is a diversifier to equities, to riskier assets. And so you can see that depicted in the various charts. The 10-year is a U.S. Treasury 10-year, and there's a better chart of this coming up. But this is a good way to plot things against each other. And this is how institutions look at it. They look at the yield curve. They look at a comparison of high yield versus government bonds. And the interactions and the crossovers give signals for entry point. But as a whole, investing in fixed income is a complement and a diversifier to equities. And I think that's the benefit to anyone listening.
Yeah.
So I think that covers this for this one.
Yeah, for sure. I mean, I just, on Zoom, people can raise their hand. And in response to that question, I saw quite a few hands raised. So there are a few people that are at least aware of investing in bonds, and Abhishek in the chat, bonds ETF holder as a hedging instrument. So we can talk a little bit about that later on as well. And we have another chart here, and I'm sure many people listening to this, watching this, are super aware that the Fed are raising rates faster than they have ever done in history. The most recent hike coming last Wednesday, which again, I'm sure many people are aware. When we look back and compare this cycle to previous years, Ray, how do you see it? Are there any key differences that stand out?
Yeah, so this chart is very informational, and it speaks to the technology and the tools that are used by institutional practitioners and analysts. So you can see the shaded areas depict areas of reversal in here in the 10-year. So as the market adjusts, like we were just talking about in the prior slide, you can see a change in regime and different signals. Prior to that, as you were noting, you can see the blue line at the bottom, and those are that's the Federal Reserve rate raising rates. So in 2015, the first, and it's noted here on the bullet point on the left, the Fed started to raise rates, but look at a slower rate. So a gradual increase. Here on the right side, you can see the same type of increases, but a lot more aggressive. And this set a different monetary policy. And now, by many people's accounts, the most recent, which is a quarter point, it's a leveling off. And without predicting what the Fed does, and I don't have a crystal ball either, I don't have a way to predict that, but you can see the effect on the economy and the prices. And we'll get to those charts of the CPI and the PPI. You can see that it's starting to have an effect on the economy and may level off. That will cause normalization and a chance to buy these assets and expect the diversification benefits. It also could be a signal for a risk-on approach, which also complements bonds, because they are really a complement to a portfolio. It's not all or nothing. It's a diversifier.
Yeah, it's quite interesting just talking about this now, because we had another club webinar, which we do every Monday, where we just use it as a bit of a weekly preview and review of the last week. And a question I asked people were, do they think the Feds are going to raise rates again, or was last Wednesday's the last one? And it was very evenly split. So it might be that we are getting to that top there. But I guess with, over, I think it's 35 days to the next rate decision, a lot can happen in between there. Look, Ray, when we talk about rates, people, I guess, are initially drawn towards interest rates, but there is also inflation rates, mortgage rates, and so on. When it comes to understanding rates, which is what our slide is here, what are those key differences, and how are we seeing things for each category right now?
Exactly. So rates, right? Rates can mean different things depending on what they show. And it's just an information plotted on a graph. And so here, I think this one is the consumer price index. And so this is the prevailing inflation effect on consumers. And you can see that going back, I think 5 years is how we plotted this. In 2022, there were strong signs And if you look back to the Fed raising rates to slow down the economy, to prohibit the increase of economic activity, essentially, to control prices. And so the CPI depicts that, and you can see very clearly in June of last year, it peaked at roughly 8.5%. Those we could have plotted that as the peak point as well, and now leveling off. And so if you're using this information to predict future activity, you can see that they're starting to have an effect. And this is a lagging indicator, a lagging rate, if you will, because it's already what everyone's paying in the consumer market.
Yeah, just before we go through the PPI one here, I saw a really scary chart just before coming on this webinar where someone had overlaid in CPI over the last 18 months with CPI in the 1970s, and it looked very similar how it went up, came down, but in the 1970s it went back up again. And I'm just praying, I'm crossing everything that we don't go down that route, but I guess we'll just have to wait and see. PPI then, how do you see this?
So this is the producer's price index. It's more of a leading indicator, and this is what the one level below what goods and services costs for companies producing and delivering goods to the market. So as you see, if this is rising, you can see a indication that there's the inflation is still making its way through the system. And this is also a survey that's produced by U.S. government. We're showing all the ones that are produced in the U.S. And you can see a leveling off here as well, peaking and then leveling off. The chart that you saw prior to this, I haven't seen, but it's also possible. And that's why the Federal Reserve controls monetary policy. That's very keen to keep track of this, and they meet on a periodic basis. And based on that information, this information, the money supply rate and other points, they create monetary policy. These are indicators to policy. These are things institutions look at. It's widely broadcast these days on CNBC, on Bloomberg, on news channels, and it's important to know what they represent.
Yeah, for sure. We're going to talk now about sort of yield curves, but I've got a question for the audience, and you can use the chat here. And I want to know how many people, when investing medium term, longer term, will pay attention to the yield curve. Let me know. A yes or a no is absolutely fine. And, I'm sure there will be many that are listening to this live and on demand that will at least have heard of the word yield curve and inverted yield curve. Why are they important? How do they, I guess, relate to market sentiment and the dreaded R word, which of course is recession?
Yeah, absolutely. In fact, and we'll wait for questions to come in, but I can start to talk about the yield curve. The yield curve is a plot of what the prevailing yield on U.S. Treasuries is throughout time. And so it's a simple plot, but the way it's shown and the severity of the curve provides different information. So here it's an inverted yield curve, meaning the short-term rates are higher than longer-term rates. That's talked about as being recessionary. So is the economy going into recession? If short-term rates are higher, and if it's a steep yield curve in this sense, then you see that economic activity and investments are staggered in a specific way, and therefore it's a recessionary signal, but not always. It's just one data point. And certainly, if you plot this chart against the 30-day, 6-month, and the shorter-term treasuries, you'll see an exact plot of how it tracked the Fed activity, the Federal Reserve changing rates. And it hasn't really played out in the longer term, which shows that the economic activity, that the adoption is not there yet, and therefore this could point to slow down in the economy.
Yeah, I'm just having a quick look in the chat. A few no's. John here. I only consider yield curves if they have a significant move, which I like the sound of that. Gradual changes don't make me change my investment plan. And it is worth noting, while they're a good indication of predicting a future recession, it's not always the case. Up next for us, and you mentioned earlier that the Fed meet regularly, 8 times a year, unless there's an emergency, which of course we had in 2020 and so on, to discuss their rate decisions, amongst other things. What does, on this slide, what does the rate even mean? You know, how does it affect businesses, banks, and us everyday people?
There's different ways to describe it. Certainly the rate in the middle that's at zero, meaning that that's maybe how the economy became in the point where it's overheated.
Yeah.
And the Fed policy basically not having a monetary policy, and here increasing rates to combat inflation. What the Fed does is it sets a reserve for the banks, and thereby controlling monetary supply. By setting the rate higher, they remove excess cash from the system, therefore removing liquidity. With liquidity slowing down, the economic activity, borrowing slows down, and that's the net effect on the economy. By lowering interest rates, and there's signals there maybe in the emergency frame that you were pointing to, I'm seeing March 2020, and maybe much deserved, the policy is to loosen the economy, the reserve requirements. By loosening the reserve requirements, you allow economic activity to continue at no rate, and so free cash, if you will, if I can use that term. I know economists really, that gets the economists' blood boiling, because that is truly inflationary, right? Free, like cash at zero interest rates. You can see it plotted that way, maybe at a quarter, 0.25% is the exact rate for a long period of time. And so now the steady increase at 75 basis points. And I think at the very end there, I just added it this week, the 25 basis points was changed last week, shows you a kind of a slower increase as the Fed is seeing it's having an effect on the economy. So I have an econ background as well. So this is how monetary policy is set. It's expansion. It's either expansionary or contraction. It's contraction here by raising interest rates.
Yeah, that's right. Last Wednesday, 25 basis hike. We will, throughout this webinar, take some of the questions. Feel free to put those in the Q&A. There's already been some good ones in the chat. Just transfer those over, and we will look at some of the products that are available on eToro. We'll even, if we're lucky, get Ray to recommend his favorite 3, if we all cross our fingers. We'll go through the different rate durations in the coming slides. But I guess firstly, why are they different? What are the differences between each duration? And what can investors, like those watching now, do about those?
Absolutely. So time value of money. This is the 3-month U.S. Treasury bill. And so it's very responsive to the Fed funds rate. And you can see an immediate increase in the prevailing rate tied to the Fed funds rate. And so each of these has a different maturity. Depending on how long you're investing, your investment time horizon, you want to take particular care to match that to the investment time frame here, because reinvesting or selling within that window can be expensive. In fact, recently there's been some activity with certain institutions buying the wrong time frame and needing to sell those, and seeing that the prices change dramatically. As yields increase, prices decrease. So you want to make sure you get that right. But if you hold something to maturity, you get your par value, the amount that you invested. And the funds work the same way. They just buy these instruments. And we have a number of funds that their cash component of the indexes, we have a number of indexes, I should say, that the cash component of the index invests in the 3-month Treasury. So it uses this as an indicator of what the cash-free rate is.
Yeah, absolutely. And obviously we've got, the 3-month here. This is the 6-month as well. Any sort of key differences between those two, and how to look at them?
Yeah, a slightly longer time period, and usually longer time period denotes higher yield, and that's the inverted yield curve that we talked about, that's the normal way of thinking of it, right? So if you're investing for a longer time period, you expect to be rewarded for that additional risk. If you're not rewarded for the additional risk, you have an inverted yield curve, which is counterintuitive to how it should work. So we plotted various treasuries this way because in academic papers, the risk-free rates for capital market modeling is the U.S. Treasury. It's backed by the full faith of the U.S. government, and it's also U.S. dollar denominated. And so many countries around the world invest in U.S. Treasuries because it's a safe haven for their investments.
Yeah. And next up, the 2-year. Anything you want to mention around this slide?
Yeah, the 2-year is actually a much talked about Treasury note. It is has been peaking, and it's seen as the 5%. It crossed the 5% threshold. So a lot of investors that watch these indicators look for specific thresholds. So the 5%, and you can see it on the chart clearly here. The 5% yield is something that's very indicative of that being. So instead of holding cash for 2 years in your portfolio, you can get a risk-free return by buying the 2-year Treasury and get 5% yield on that, which is remarkable compared to where it was just in June of last year.
Yeah,
you can see that plotted here. So that's a significant change, and that's what the information tells you as far as the new regime that the Fed has created. And there are other ones actually on here. The 10-year and the 30-year also give you additional information. You can note here that the 10-year is a choppier and less reactive note. The jagged line, and it's and the 10-year is always talked about as in the U.S. market as an indicator for the mortgage rate. And so as this increases, the additional credit required to borrow is tied to the 10-year, even though most mortgages are 30-year mortgages. This is a good indicator of this. So as the Fed raises rates, they affect the Treasury yields in the various tenors differently, but they also affect the mortgage rates, and they can slow down the real estate market or create a recessionary, have a recessionary impact in the real estate market by raising rates. So less activity, it's harder to afford housing at this rate. It'll have a downstream effect on rent, etc., as you can imagine. So that's what the information the 10-year gives you. That's certainly a more rigid return. The 30-year, again, less than 5% yield. It's plotted on the yield curve, and you can see this is the longest tenor that the Treasury has, and I think that's the information on those two.
Yeah, I mean, when I first started getting involved in finance, it was a day trader, and some of the products that I was trading was the S&P 500, oil, gold, and T-notes, the 10-year government bond. And actually, it was one of my favorite markets to trade. It was very reactionary to US data. So we talked about the CPI, PPI. If that came in better or worse, the T-note would react accordingly. And actually really liked trading it there as well. If we move on then, so we covered those different durations here. Over the last few years, I'm sure people are probably sick of the buzzwords, correlations and diversification. They've been chucked around an awful lot, but it's important that we cover them. And when it comes to correlations between bonds and equities, how do you see that? Is there one, or does it depend? And what does the data, if there is, show us?
Yeah, so if you look over a long period of time, and again, correlation is another rate. So correlation rate between two different asset types. And here we used indexes as we operate at NASDAQ. You can see the correlation between different asset types. The Euro Stock 600, obviously an indicator for the European market. The Nikkei 225, an emerging markets indicator. U.S. Treasuries, corporate bonds, and U.S. high yield. This is the correlation to the S&P 500. And we certainly have our own indexes, but it's a commonly used indicator. And the most important point on this slide, I think, is the negative correlation between the U.S. Treasuries and the S&P 500. Again, this is over a longer period of time. You do have times of concern like sell-offs where we've seen bonds and equities follow the same trend. But if you look over a longer period of time, and certainly everyone has a longer period of time for investments, so not a 30-day or 60-day time horizon, you can see that the correlations hold. So this makes a compelling case to diversify using bonds and also capture the yield that we just talked about as opposed to sitting in cash. A lot of the retail platforms we observe have many clients, especially wealthy clients, they're sitting in cash and not taking advantage of the risk-free rate of treasuries. Some of the work is just aligning your time horizon with the proper U.S. Treasury that we talked about or bond that we talked about. Here, notably, the U.S. corporate bond is also not correlated zero. So that's a great diversifier. Also, the 60-40 portfolio is always thought of as equity plus bonds. And so here you can see there's correlation. There's a diversification effect for each of these asset types against the S&P 500. Some better, some not, but there's some preferences there. And I noted that on the eToro platform, there's a number of indexes and choices available to the investors to take advantage of and use your platform to identify where they want to be. How much diversification do you want? How much risk do you want to take? That the various asset types have different risk profiles, such as corporate bonds and high yield bonds are riskier than U.S. Treasuries. Certainly emerging markets are going to be riskier than other markets.
Yeah, for sure. I think this data is really important for investors to understand with correlations. It's a good way to play it. If you see a certain market behaving one way, moving a certain direction, and the historical correlation suggests that that market goes the other, you can play off that, certainly on the shorter, medium, and longer term as well. Just going on to diversification a little bit more, a lot of people's favorite buzzword. How can investors use it when it comes to fixed income? How can we use it via bond indexes? And what are the potential strategies that people could look at?
Yeah, and this goes to what we do here at NASDAQ, and certainly many others do. And I try to use a third-party source that's very objective as far as the levers involved with indexing. So indexing employs the rules around diversification by picking a basket of securities. So now you don't have risk to one individual entity. You have a diversified risk. You can diversify your risk against the various durations. And by creating a rules-based systematic approach, what you've done is you've created a capability to invest in an asset type and have the index do the work for you, the selection, the balance and rebalancing. And you can, there's a lot of reputable companies such as NASDAQ that do this work across asset types. Passive, purely passive, it's all completely rules-based. There's also more specialized indexes that target a specific asset type by screening or weighting the index slightly differently. And those are called strategic beta. This is a very popular term that was created in the retail market by Morningstar, and hopefully a term that users or investors with eToro have heard, because it's always talked about as, some call it smart beta or strategic beta because of the weighting and the screening that's shown here. And then the active strategies is really a self-selection by the asset manager. It's more of a traditional fund approach. And there you have a more subjective approach to what is risk and what is not risk. The tools that you're given on the platform allow you to do this for your own portfolio, or there are funds that are actually also actively managed that do this work for you. So that's the whole gamut of what's available here. Because of technology, Sam, a lot of the passive approach and strategic beta approach addresses a lot of the risk and weighting and pivots and dynamic exposures that traditionally were only available in active. And so those are the highlights from this screen.
Really interesting. And I'm quite looking forward to this next slide when you sent it over and I was having a look through, because there'll be a few investors and traders that would have at least heard of the traditional 60-40 split.
Yeah.
To keep it very simple, for a lot of people, it means 60% dedicated to stocks, 40% to bonds. However, over the last couple of years, people have started to say 60-40 is dead. It's done. It's finished. It's time to move on. Yeah. How do you see that, Ray? Is that true?
Well, I've heard the same thing. And every time there's a transition in monetary policy, during that transition, asset classes work together. They're collinear as opposed to provide diversification. So last year, as an example, everyone was saying the 60-40 portfolio is dead and why invest in that? And all of a sudden in 2023, you can see in the chart here that it's made a comeback. It's a time to stick to diversification and utilize 60-40. It's very basic allocation between the two asset types, equities and fixed income. Fixed income, because of the correlation that we showed over the longer time, provides a great balancing to a equity portfolio and provides income in the portfolio as well, a different type of total return that's a benefit to investors. Again, the indexes can track these asset types, and that's the study here that we pulled from Bloomberg.
Yeah, absolutely. And it was quite interesting. We were talking about just before coming on today about some of the headlines that we've been seeing around, fixed income. People are starting to get quite excited about it again. I've seen headlines like return of the bond and stuff like that. So it's an interesting time in the fixed income space. Next up for us to discuss is asset classes as diversifiers. So if we move on to here with the passive approaches tied to rules-based indexes, what's the main takeaway from here?
Well, diversification is really tied to balancing risk across issuers and across issuances as well. So, for instance, the 30-year Treasury is an issuance. If you buy only that, you're taking a lot of duration risk, right? So, an issuer, the U.S. government, and then the various issuances. So finding the right balance is tied to an investment horizon, buying the right index via the product that's available on your platform. You can identify and align yourself for the proper return to your risk. The indexes also rebalance to that same diversified index. So that's a process that's built into the index. So on a monthly basis, for instance, for our fixed income indexes today, we rebalance the index and cap the exposures accordingly. And any cash that was paid in the index via the coupon payments gets reinvested based on the rules of the index. The rules of the index are described in the methodology. It's very transparent, so you know exactly what you're buying, and you're assured the fund is following the index because it's tracking it from either an ETF, an exchange traded product, or a mutual fund or other vehicle. But nonetheless, the index follows these rules, and it's a good way to diversify and have that transparency. And the names and the descriptions will show you exactly what the index is supposed to do. And there's some examples later that we can dig into.
Yeah, absolutely. And it brings us onto this slide here. And I really like technology enables innovation, which is so true. And access to these products is the easiest it's ever been. I mean, you go back 20, 30 years, it was nigh impossible for a retail investor to get involved in these kind of markets. So moving on to this slide here, and maybe in a bit of a summary, how can our listeners today find this sort of useful information? We've discussed a lot already, but they may want to find out more, or at least know where they can go and find it. So what have we got?
Absolutely. So technology does definitely drive innovation. At NASDAQ, we've benefited from that. That's the cornerstone of everything we do, top down. We always talk about innovation and thinking differently. And so here you have the eToro platform, lists all the available securities and a lot of research, a lot of video and written papers that support the methodology around this. The information is available also from the fund companies, the index providers such as NASDAQ. And I didn't want to make this just a NASDAQ thing. So I there's many other index providers. I actually use some of them. So but NASDAQ being one of them. And also other independent sites, the third parties. Morningstar is a retail platform. They provide ratings and great information around a number of facets around fixed income and equities. They have a star rating, etc. I'm sure everyone's heard of that. There's the Morningstar.com, I think, is their website. Bloomberg is an excellent choice. Also, Bloomberg has a website where all the various products are available for retail usage. There's also an institutional product that I use. Some of the charts you saw came from the Bloomberg terminal. We cited it as such. And there's a lot of good information there as well for the website. And Yahoo Finance is another third party that's available. And there's many other local language and local market tools available to the investor. But mostly, since you walked me through the eToro platform has a wide range of capabilities. Users that have a track record or even want to talk about how they approached their investment process can publish that. I'm using probably the wrong term for it, but they can be tracked by other users. And so it's pretty fantastic. Again, leveraging technology to get there. Years past, was that available? It really wasn't. And today, the new investor has all the benefits of these platforms available to them. And we're using the technology to create these indexes and also educate the users based on that.
Yeah, I absolutely echo that. I really do. And, there was a time where it was thought that to be a top investor or top trader, you would need access to a terminal or a live news feed and have 15 screens in front of you to be aware of everything that's going on. But that's just simply not the case now. And those websites that you've listed there and providers, yeah, absolutely would be recommended there. The next slide here. What have you got for us, Ray? I'm just having a quick look at the questions. So I'll put together some of these questions for us at the end.
Yeah. The one that just flashed across, there's an answer for that too. It only shows it for like 1 second. But I did read it, and there's an answer for that. I think a lot of these points we covered, and it's just kind of a recap, if you will, on this chart here. So cash and interest rates are very important. Cash for the last few years has had no interest rate. So you sitting in cash was foolish. And if you're sitting on cash now, you should look at other alternatives because you can basically, at a risk-free rate, look at U.S. Treasuries, bills, notes, bonds, and there's a way to invest in them. We'll get to that. Cash, aligning yourself with the time horizon. That's really important. So the various products work based on a different time frame. So you need to align yourself there. As far as that, there's also a blog write-up that we did on the yield curve and treasuries that we'll share with eToro to post, and that a lot of this information is reiterated in there. And we really hit these other points, the inversion of the yield curve, points of inflection, and then the glossary of terms. That there actually is a good glossary of terms on your platform. And so that's a good place to go for education. And we hope to be invited back on to walk through these in the next level of information that's available.
Yeah, absolutely. And another hot topic, actually, which we can touch upon, and we have briefly throughout, is mortgage rates. Very hot topic right now. And it's really interesting to see the two graphics that we've got here and the differences. So when looking at them, from 5 years to 1 year, what really stands out?
Well, I think if you live through the spike in interest rates from basically a 2-3% level, I think you can see on the left side there, and the leveling off of interest rates, it's a shocking increase, right? It's tied to change in monetary policy. But as things have leveled off, you can see it, that this is actually looking back 5 years on the chart on the left. Maybe it should have been inverted. The chart on the left, you can see that looking back 5 years, the rates aren't the highest they've even been for the last 5 years. So it's a very doable. Everyone's been spoiled by lower rates, and it's fueled this growth and maybe inflationary growth in the real estate and retail real estate homes. But the leveling off is not even a high point within the last 5 years, and certainly the affordability is there. And so once the rates are leveled off, you'll see a return to a normalized real estate market, and it's not as shocking as it seems as the one-time increase. And I think I ran this chart for us a couple of weeks back. Even now, if you look at the chart, the prevailing rate's actually lower than this. So things are leveling off, and these are great indicators, again, to check rates, to be comfortable with the prevailing information that's out there that's driving affordability and products that are available to you in the marketplace. So as an investor, I think everyone, at least in the US, their price of their home and the equity in their home, it's a big portion of their assets. And so always have to keep an eye on this. And if people who have refinanced over the last 3-4 years have really benefited from the lower rates, but the affordability is still there.
Yeah, absolutely. And that really brings us to almost the end. I've got a few more questions for you, and we'll go through some of those in the chat as well. On this slide here, so we'll run through a few bits. There's the NASDAQ-based indexes available on eToro. So, I mean there's 1, 2, 3, a fair few there. But when looking at these, Ray, what are the differences? Which ones really stand out to you? What purpose do they serve? That kind of thing.
Sure, absolutely. These are, and I can only talk about the indexes because I don't want to recommend any of the products. So it's very plain and simple listed there. NASDAQ tabulates a number of indexes. They're used for some of the best performing products in the marketplace. And by performing, it's tied to your objective. It's not based on total return picture. And so you can see from the range of the NASDAQ 100 that's available on different platforms. The NASDAQ 100 is the top 100 companies listed on NASDAQ minus financials. And so in the recent history, for instance, financials had a very volatile month or so of activity, but the NASDAQ 100 is only companies listed on NASDAQ without consideration for anything in the financial sector. And so it's not 100% technology, it's only roughly 50% technology. And you can see in this chart various iterations of the NASDAQ 100 and the various names and different screens, which are the strategic beta that we talked about earlier of the exposures. And so we certainly hope that other indexes that we've launched, the representations will be available on eToro, and we'll work with you to do that. But these are the ones that are currently available.
Yeah, and someone in the chat just mentioning CNDX is their favorite, which is always good to get a little bit of a shout out there. So if you're great, how to invest in fixed income eToro, well, just separately, all of these indexes are available on eToro, and also over the next, I think we've got 3 slides where this, as you see on your screen. So these are passive index based products available on eToro. I mean, people at home, should be able to hopefully see that if you've got a big enough screen. If not, just take a quick screenshot. So you can see here, these are all the different pages. So, I mean, we're not, Ray, luckily for you, I'm not going to ask you to go through each one. But is there for you anyway, when looking at this, is there a little bit of a summary? Is there ones that you favor that you think can meet investors' expectations?
Absolutely. And so you can see, and I'm only going to talk about the indexes. And so everything that's listed here, Sam, is available on the eToro platform.
Yes.
For the description of the indexes, the name of the indexes, a lot of times the index name is in the actual fun name, so it's easy to figure out. I certainly think that anyone that studied the fixed income world, so the questions were, where can I purchase, or how can I buy fixed income in eToro? Okay, so I think you're looking at the screen. This is one of three. There's 3 pages. And I think if I wanted to list these with bigger font, I would have needed to create it like 15-page screen. So for everyone's benefit, there's only, I think, 3 pages of these, but we'll make these available to everyone. But they're actually, more importantly, available on your platform. And what you can do is to look under your ETFs, available ETFs, what used to be called the Barclays Ag, now called the Bloomberg Ag, because there's a combination of index providers, is a great it's a great product. It gives you very diversified exposure to U.S. Treasuries and corporates. It is the really, and a number of these top asset providers provide access to that product. So anytime you see the aggregate, there's a couple on the screen here as we're looking at. And the middle part. So look for the U.S. Ag. It's an aggregate index that provides exposure to the U.S. Bond market, U.S. Treasuries, as well as corporates. So that's a very good combination index for everyone to look at. From there, studying that, there's different versions of that same index. There's a Treasury-only version of that index. And that you can see throughout the list here, there's various versions of it. Bloomberg, if you look for the name under Bloomberg, you can see a number of versions. These used to be called Barclays or Lehman Brothers, prior names to the indexes. And I think that's worth highlighting. Because we just did a whole session on treasuries, I think you can look at anything with treasury bills 1 to 3 month. There's one listed right on the screen here, just by coincidence, is one to look at. Those are provide exposure, perpetual exposure to the 1 to 3 month treasury, the 1 to 5 year treasury, the 10-year note, the 30-year treasury. There's so many versions of this. And I must admit, in looking through this, there's a wide range of products available. And because of the diversification effect, because of the rules-based, transparent approach to indexing, you really would benefit from buying a diversified basket using ETFs, as opposed to buying individual bonds where you don't have the benefit of diversification. If it's a corporate bond, you'll have the exposure to the issuer. Even if it's investment grade, there's still a rating tied to investment grade, especially if it's high yield or emerging markets, then you have exposure to the specific country, emerging markets being higher risk, high yield, which by nature, by definition, is higher risk, lower quality. The term junk bond is used, but maybe goes a little extreme with the definition, but it's high yield. I think it's a more politically correct way to call it now. And then banks also issue a number of bonds that are adjustable to inflation, or to inflation rates and things. Those are bonds that are senior loan bonds, and you can see in the product names or in the index names, there's different representations of those products. The indexes basically create a subsegment, a more specialized exposure to those types of bonds. The U.S. Treasury also issues, for another favorite of mine, and I'll stop talking in a second here, Sam, sorry, is, as you can see, I love bonds. And
yeah.
To look at bonds, right? So it's the TIPS. So the TIPS are U.S. Treasury issued bond that adjusts for inflation. It's an inflation-linked bond. And so what that does is the Treasury then uses the CPI to reduce the to enhance the performance of the index. And that is, if you're concerned about inflation, your take-home yield, then anything that has TIPS, TIPS. I can see some on the screen here, and certainly the index is properly called out as U.S. Treasury Inflation Linked Bond Index. Those provide a level of protection against inflation. So the work's already done for you, in addition to the tenor and things. Those are all described in the fund description, in the index description, the index methodology, and etc. So the platform, the technology really enables you to take advantage of this.
Yeah, absolutely. And I'm sure there's some people at home that have just screenshotted a few things, and Elias BND is one that they invest in, and all of these are available on the eToro platform. You can find them on the ETF in the discovery, or to search the name, which you can see down the left-hand side of this. We're going to cover this slide in a moment. But there is a good question, which I feel is kind of relevant now. So I'm going to chuck it in before we get into the Q&A. And you kind of touched upon it there. Well, when selecting a bond or index, how important, or what importance, I guess, should one give to the rating? How important are those ratings?
Right. Well, there's different kinds of ratings and rates. The rating, if you're talking about the retail available rating, like a Morningstar star rating, or the credit rating. So I'll answer both. One is they take Morningstar provides star ratings, and they take great care in describing how that rating is tied to the category, and it has a specialized, informative nature to it. And so take that within the context of its definition. It's meant for an informational piece. It's not all encompassing information. Sometimes past returns, as we say, is not indicative of future returns, right? So if you're looking at a rating, it's based on the past returns, and is it indicative of the future returns? That remains to be seen, right? So that's the caveat with ratings. Then there's also credit ratings, where investment grade bonds and high yield bonds are differentiated between the various ratings that the credit rating agencies provide. Who are those? The main ones are Moody's, S&P, and Fitch. They provide ratings on the individual bond issuers and issuances. And those help us determine which baskets of bonds are investment grade and which ones are high yield based on the various ratings. And again, that's done by their analysts, and it's called credit rating, credit analysis. They do a good job compared to what they're up against, but there's still information that's not accounted for in those ratings too. So that's also the caveat to those.
Yeah, absolutely. And on this page here, we've listed some of those fixed income security types, many of which you've touched upon now. So feel free to mention anything about that, as well as this slide here. What are we looking at when this slide comes up? It looks very pretty.
Thank you. Well, I'll take it's a Bloomberg description of the this one's the aggregate the ag bond index that I was talking about, and so this is the makeup of the bond, the description of the index. This is all an index comprised of number of bonds, and it's a description of how it's constructed. It's adjusted for float, which is the available tradable available amount to purchase, and so it's very kind of a rules-based construction of the index. And this is one of the ones I liked as an index. So I put the actual screens of these for everyone to look at. It describes what the top holdings are and what the returns profile is. And some of this information is available by pulling up the bonds or going to the index provider's website, and you can see what's available. Again, from the prior discussion that we had, the fund provider also, I don't want to necessarily recommend any products. I want to stick to just the indexing capability, but the US Ag is available almost by every fund provider. Will have a page that describes their take on this, their investment around this. And it's a very large index, and so therefore there's subsets of it. If you want to invest only in US, only in high yield, only in investment grade, you can get subsets of this master index.
Yeah, and I'm wary that we've sort of used the hour up. So I think now would be I know you mentioned a few of these things. Now would be a good time for us to sort of run through some of the questions that we've got. So if anyone does have any further questions, feel free, guys, just to pop them into the chat. There's one that I saw earlier, which I think was quite interesting, and it was about from an investing standpoint, if my time horizon for investing is usually 6 months, are bonds for me, or is that too short term? What would you say to that?
Well, you can clearly there were shorter term instruments available in our presentation, so you can plot out, and for analysis, you can see what the yield for the 3-month treasury was, and then you can do that twice. Or there's also a 6-month treasury that you can purchase to match your investment time horizon to buy that instrument or the fund, depending on your approach. But so no, it's not too short. Definitely there is that matches up with certain products are available, indexes that track that shorter time period.
Amazing. Another one here for those that are maybe sitting in cash for whatever reason. Maybe that is after getting out of investment that went well or bad, or they're waiting for a dip in the market of a certain percent. What would be the argument to say, actually, you know what, fixed income is a good in between for that?
Yeah, and it's really trying to time the market, and everyone tells you that it's best to invest in the market and invest for a longer period of time and not try to time the market. And anyone that recently has tried to time the market because the market's been very volatile maybe has learned that lesson to see it's very hard to time the market. Time in the market is maybe even better. So these indexes provide information about what you would have looked like, diversified return combination, if you had it just bought and held for a time period. Even last year when the 60-40 portfolio was not performing, if you held your portfolio through that time period, you would not have felt the effect of selling into that market. Selling into the market, trying to time the market, causes problems. And not aligning yourself, especially with fixed income, with a time horizon, creates that risk that you have to go sell an instrument before it's ready for, if it's due for maturity, into a market where the value may have fluctuated because it's tied to interest rates. So,
yeah.
So I hope I answered that question.
Oh yeah, absolutely. And I was just thinking what a amazing webinar it's been. We've had so much information. I know there'll be people that'll be watching this on demand as well. So if you are watching on demand and you couldn't attend live, welcome. Hope you've enjoyed it. We have another question here. This is quite a specific one, Ray. So if it's too specific, then you can say pass. But here we go. If I buy a 3-month ETF with an average return of 4%, what is the risk for me in 3 months when I want to sell it? Am I exposed to the fluctuation in the ETF price? Is that possible to answer?
Yeah, I think you would be. Again, I don't want to give any investment advice, but from my understanding, you would be. Maybe we can come back to that question separately.
Yeah, absolutely. It'd be good to have a follow-up to this. Guys at home, this is the final call for any questions. I'll be reading those out. I'm just going to have a quick scroll through the chat at the moment. I see a few people raising your hand. If you just type away your question, you'll be able to have a look through that. A few people in the chat saying, yeah, they use it as hedging instruments. Some have said they use up to 20% of their portfolio at the moment is bond related. We've got a question here, which I think we've already answered, Ray, but it was, what role does rating play when deciding between bonds and indexes, or what weight should be given to rating when choosing a bond or index? We've covered that, haven't we?
I think so, yeah. Well, the credit ratings are included in the index rules. So the index accounts for the rating between investment grade and high yield, and will make adjustments based on the quarterly, monthly, annual rebalance of the index, so that if you're concerned about rates, by buying an index-based product, you get the benefit of the ratings.
Yeah. Last couple of questions. One is actually from me, and they say in markets that the bond guys are the first to know. They know if something's going to happen, they're the ones that you need to listen to. Would you agree with that?
Yeah, if since you worked on the trading desk, I'll come back to you with an analogy that the equity desk, trading desk, and the fixed income trading desks are very different types of personalities, right? And so the bond market looks at credit ratings and a lot of leading indicators, and the equity trading market's reacting to the market activity, and so they have to be different. There's different dynamics to those markets, and so that's maybe what leads to concern. But then also the fixed income market is tied to risk mitigation, and so anytime there's inverted yield curve or some of the things we talked about, the fixed income strategy is to mitigate, to control risk, and also it's a much more capital intensive product that in some ways is constructed differently than equities. And so those differences are a good diversifier for equities, and certainly they behave differently. And since I have a fixed income background, I'll answer that accordingly, like that.
Yeah, perfect. And look, I think it's an area of the market that people need to consider. I asked the question earlier, has anyone heard of the yield curve? And there was quite a few no's, and hopefully this webinar has been great to address that, and hopefully we can have a follow-up as well. And with the link that people have clicked on to join, you can all watch on demand as well and take your time to do that. But that really brings us to the end here, Ray, and I just want to say thank you from myself and eToro for joining us. It's been very educational and informative, so thank you very much.
Thanks for having us. Appreciate it.
Take care, everyone. I hope you will have a good rest of your day, afternoon, evening, if you're watching on demand as well. I hope you enjoyed that. Take care, everyone, and we will see you soon.